What is your risk capacity? Not your risk tolerance, but your capacity. This is something many of you have not even thought about as you get closer to retirement, and even as you build up your nest egg leading up to retirement. And your risk capacity will change over time, but you need to make sure that you adjust as you move forward. And in today's video, we brought on Brett Martinson again from our team. Again, Brett's based out of Ontario, works with our retirement planning team. We work with Canadians coast to coast. So if you need help with your retirement plan or have questions, please reach out to our office. But Brett's going to talk about investor profile, investor questionnaires, risk tolerances, and most importantly, risk capacity.
So Brett, thanks so much for joining us back on the channel here again today. Great to have you again. Today we're talking about investment risk, investment profile, which many of our viewers kind of wonder, like, am I in the right type of investment risk? Am I taking too much risk, time horizon? So we want to break that down in this video. So I'll let you take over again today and kind of go through your content here that you want to touch on. But again, this is something we see in and out of our office every single day with clients. So we thought it'd be important to share some details and some resources that Brett has for you here going forward.
Yeah. So what we see a lot is I'll go back a couple of years ago when the markets went down and or even back to 2020 or 2008. Pick any year where the markets went down and stayed down for a while. This comment always came up was, oh, the markets are down. What do I do with my money now that I'm getting ready for retirement, or my plan says I supposed to be withdrawing money, but the markets are down. And that's the whole point about this, is that how do we set up our funds in a way that can deal with that? We did a video on that, but also setting up the funds for your investor profile, which is going to be different than your uncle's, which is going to be different than your neighbor's. It all has to do with various things, not just how much risk am I willing to take on, how much of the ride I'm willing to do. So this website here, this is the CIRO. We'll have the link in the description below. It's the merger of two regulatory organizations that got together about a year ago. And this page here, Understanding Risk, does talk about risk. A lot of people think that risk is the volatility, the possibility of something going up and down, or the possibility of something going bankrupt. But the thing that they don't necessarily get into is the risk capacity, which I'm going to pop into another page on this website in a second. But risk capacity right here is your ability to get hit with a financial situation and bounce back from it. Risk tolerance is, I don't care if my money drops 30%, I'm growing for the long term. Risk capacity is, my money just dropped 30% and now my life has changed because of that. So this page here, you'll see down towards the bottom here is an investor questionnaire. This is a free tool. Is it the best tool out there? No, there's more tools out there that do have more science behind them. This does have some science behind it, but this is a free tool. The other ones typically are paid tools. So we want to give people something that they'll have access to, that they can get access to easily, because I'd rather them use this tool than nothing at all, as it were. So if I go over to the questionnaire itself, and I've jumped to the risk capacity section. So there's about 15 to 20 questions in total in this questionnaire. It takes 10 minutes to fill out maybe. But let's look at the risk capacity questions here. This whole section is on that area. So what is your annual income? The amount of money that you make potentially gives you the ability to deal with financial situations differently or better. Has nothing to do with how willing you are to take risk in your investments. Is that current and future income source stable, depending on the type of industry you might be in? Most people may say that no income is completely stable, and I would probably argue that they're probably right. And then how much savings versus debt do you have? What is your estimated net worth? These are things that I don't think the average person considers when they are going to invest. They consider, I want my money to be safe and I don't want it to go up and down with the market. Okay, GICs, money market, that type of stuff. Or I don't care, I'm willing to take on all the risk, marijuana stocks, new technology, go for it. Great. But none of those things has to do with what these things are talking about, which is your risk capacity.
And another one we see often too, Brett, is that, I'm getting close to retirement, but I haven't saved enough, or I got divorced, or something happened in my life where I'm not where I was hoping I would be. And I need to take more risks to get to retirement in time, which is, a deadly weapon.
It is, because I often say that we do the most damage to our investments when they go down further than we expected them to do so. So let's use 2008 and 2020 are my favorite examples, because both times the markets went down drastically, but differently. 2008 took a while to hit the bottom. It also took a long time to get back up to the top. 2020 went down in a week. It was like just out of nowhere, but it also came back relatively quickly. So if we look at those two examples, and if people kind of slept through those and said, well, yeah, this happens, I've got time, no problem. But if other people said, I had one client famously in 2008, they said, I don't want, my money went down 4% and I couldn't sleep at night, right? I had this client after 2008, but most people would say a -4 in 2008 was actually a win. But that's the whole point. If you can't sleep at night because your money went down a certain point, certain percentage, then we've got to look at that. The other thing, as you said, the funny thing you mentioned about the fact that I need to take on more risk. I need to make 15, 20, 30%, put it all in Tesla and let's hope it works out. What I find interesting about that is every year when the CFP exams are done, the FP Canada gives some feedback on those exams. And I've talked to instructors who help prepare people for those exams. And almost every exam, if not every exam, one of the feedback is a lot of people suggested increasing the risk to ensure that the client met their goals. And this is something that we cannot do as certified financial planning professionals. We need to figure out, as I tell clients, how fast are you willing to drive on the highway? And we can't go any faster than that. So if you are a 60-kilometer-an-hour country road driver, then putting you in the 130 lane of a 400 series highway is not right for you. Absolutely.
And for viewers wondering, like, CFP is Certified Financial Planner. So that's a designation that Brett and I and our team carry. So that's kind of the highest level of education and the experience and all that in our industry. FP Canada is our governing body. So they're the ones that host and maintain our ethics and standards. They do our exams and all that kind of stuff. So when you hear these, like, what is FP Canada? What is CFP? That's what they are. So that's kind of the governing body and the professional designation that we use in our industry.
Yeah, exactly. So I encourage people to go through this. I'm just going to jump back to that other page just quickly here. Again, the links will be in the description, but you just need to agree to the terms of service. And then you just go through the questionnaire. So this one is on time horizon. There'll be a bunch of questions on risk capacity. There'll be a bunch of questions on risk tolerance and so on. And this will give you an idea about what your investor profile is. Very conservative, very aggressive, anywhere in between. And again, it's not just based on the risk you're willing to take on, but the risk you should be taking on. And I know we wanted to touch on time horizon a little bit, Adam, before we finished off here. So on the time horizon thing, when we're accumulating money, usually for a retirement goal, our time horizon is I'm retiring in the future. I just want my money to grow at some rate, conservative, aggressive, anything in between. As we near retirement, you can see here, when do you expect to withdraw a significant portion, 1/3 or more? This question, I understand why they're putting the question here, but I would rather answer this question of when and how much am I planning on withdrawing? Because if I'm planning on withdrawing $50,000 a year from my retirement savings in 3 years from now, when I plan to retire, well, that $50,000 should be sitting in something relatively low to no volatility. We've touched on this in another video as well, because that money I don't want to go up and down with the market, hit a 2008, and now we're down 30% and the market hasn't recovered. The other portion of my investments let's call it 90%, 80% of it, yeah, that's invested for the next 3 years, 10 years. That's invested for the longer term. So we have these kind of different buckets now. Cash wedge strategy we've talked about, where some money is coming out in a relatively short period of time. That should be invested differently than the money that's going to be coming out in 5 years, than the money that's coming out in 10 years. And Adam, I know you've made the comment before that, again, using the example of $50,000 a year, for some people, that's 5-10% of their portfolio. For other people, that's 20-30% of their portfolio. So that's where this 1/3 or more is a little bit, it's not as detailed as I'd like it to be, because even if it's still 10% of your portfolio, that's $50,000 I don't want to be down 20% when I actually have to take it out for my retirement.
Yeah, exactly. Yeah, when you're talking about like time horizon, risk profile, all of that, that's where, like, for a lot of our clients, we refer, so we're obviously a financial planning firm. We have clients that have investments at a third-party investment firm called BCV, stands for Blue Chip Value. But why we like working with them, and even we refer some clients to Steady Hand, some of these firms, what they do well and why we like to refer clients to them and connect with them is they take our plan. So we build a plan for a client and we say, okay, you need $50,000 out of your RIF next year when you retire. We then show that plan to the investment firm, and they actually make sure that $50,000 is in a 1-year bond that matures, in a high interest savings, whatever it is, but it's liquid. So if the market drops 30% next year, their cash flow is still there, ready to go, regardless of what the market's doing. And typically you want 2 to 3 years of that ready to go and keep that rolling. And so as you watch this video and you kind of go through, what is my investor questionnaire and profile and risk tolerance and all of that, you then need to piggyback that into, what's my retirement plan look like? How much cash from which kind of buckets do I need? And then the step from there is my money being managed properly? And a lot of DIY investors get out of DIY in retirement because there's a lot of moving parts to it. Like, you need to kind of structure it in a way where next year, like, you're relying on your investments to provide the cash flow. So you need to make sure your investments actually line up with your plan. And that's where most plans fail. It could be a great plan, but the implementation and the investment strategy behind it is faulty. And you need to make sure you have 2 to 3 years of cash flow. We've done many videos on this, but the plan and the investments need to work together. And most of the time they're not. And a lot of times it's, oh yeah, I'm getting my, high yield dividend over here. I'm getting my bonds, or I like my growth stuff. We don't care what you invest in at the end of the day. We care that the plan and the investments line up so that you can relieve that stress off yourself through retirement. That's the important part. But step one is what we talked about here, is what is your risk tolerance, your risk profile? Like, what does this look like for you? And a lot of you haven't gone through this process. And some investment people don't do this questionnaire anymore. It's more of a verbal, they go through the questionnaire through a conversation, which again, a lot of the firms that we use do that, and it works well because they've done it 1,000 times. But if you're doing this at home, jump into this. Again, we'll link it below. Go through this, get a rough idea in your head what this should be looking like.
Absolutely. I think everybody should be going through this and go through it every few years. Your investment advisor should be at some level, as you said, whether it's a verbal questions or something more formal like this, but everybody should be checking in on something like this and just getting a sense of the weather, as it were.
Yeah, exactly. No, good information. Thanks so much, Brett, for joining us again. We'll do this again soon and provide some more content to our viewers to help them move forward to a better retirement. So thank you, and we'll see you in the next one.
You bet, Adam. Thanks.